And thank you for standing by. At this time, all participants are in a listen-only mode until the question and answer session of today's call. At that time, you may press star 1 on your touch-tone phone. Today is being recorded. If you have any objections, you may disconnect at this time. I will now introduce your conference host, Dr. Heather Brown. Ma'am, you may begin.
Welcome, everybody. Appreciate you during this busy holiday season to join our webinar. We're excited for the content that we have to share with you today. I'll be hearing from Maria Sinnott from the Credit Bureaus Alliance, and is the Manager of Training and Program Development there. And I saw her speak at a conference, and she did a wonderful job, and I thought it would be great to have her present to our Finex audience as well. So before she comes on board, I just wanted to run through our standard disclaimer. This presentation is being made by a Bureau of Consumer Financial Protection representative on behalf of the Bureau. It does not constitute legal interpretation, guidance, or advice of the Bureau of Consumer Financial Protection. Any interviews stated by myself or the other presenter are our own and may not represent the Bureau's views. This was used in support of a live discussion. As such, it does not necessarily express the entirety of the discussion nor the relative emphasis of the topics within. The Consumer Financial Protection regulates the offering and provision of consumer financial products and services under the federal consumer financial laws and educates and empowers consumers to make their informed decisions. I know already that you're part of our financial education exchange. The way to know if you are is if you got an email ahead of time telling you about this webinar, you're a member of the exchange. If you found us on the web page and joined that way, then send an email to the address at the bottom here, cfpb_finex@cfpb.gov, and join the email list and be a part of our exchange and get notice for everything. For regional convenings, so you can reach out to us if that's something that interests you. And we also have all of our past webinars we post online. We send out about a monthly newsletter, so you won't be overwhelmed with news. Mainly, we let you know when we're having a release of some research, a tool, or a webinar. So here I just wanted to share the page that you go to look at past webinars. Do a screen print if you'd like, so you can get the actual webinar URL address there at the bottom. And many of you have already found that page and visit it regularly, so great. Thank you for that. Just to let you know where some of the Bureau's portal, some of the Bureau's information is on credit reports and scores. We have a portal dedicated to that, and it has a lot of information on it that you probably find useful. And definitely, if it's information you already have, there's some things that you'll find useful to share with your audience and your clients and other consumers. And this is the web address at the bottom for that. And basically, this the information we have here talks generally about credit reports and scores. It also talks about understanding your data. We have a worksheet that tells you some specific things that you should go through and check on credit reports that you can give to clients so they have a little checklist. This explains where to find free access to a credit score. We have got the names of financial entities and credit card companies that provide free access to credit scores and put them in one document. So this link will take you to that location. Many of you already have sources to help your client, and Maria is going to talk further about some ways that you can get access to the credit score, so I won't go too deep in there. We also have an explanation about one of the questions that we hear a lot and came through loud and clear on the request for information was that people said, well, there's so many different credit scores. The one I was by my lender that denied me not the same score that I saw when I went to get it. And Maria's going to touch on some of that today, so I'm not going to go too deep. But we also have further explanation about why you see three different numbers or you may see three different numbers from three different bureaus. Why the score that you're looking at it might be different than what the lender provided you, and those kinds of questions. So you have questions around that, listen tight to the presentation, and if you still have some, you can ask myself or Maria at the end of the presentation. When the presentation ends, we will have a question and answer session. and so we'll take as many questions as we can, and then we'll wrap up. Also, for those of you that are getting a copy of the slides, we do have the presentation posted, so you can download that. If for some reason you have trouble with that, if you go and send an email to the CFPB_FINEX, FINEX at CFPB.gov and ask for the slides, I can also email them to you, but you can download them. Okay, you'll see two set of slides, my introductory slides here and the actual presentation that Maria's using. Resources for FINEX, the general web page that's sort of the information we have, the email address for signing up for the exchange, or if you want to change your address. We get people that actually move to a different job and get the reply that they're no longer there. So don't forget, when you get a promotion or move to another job, make sure you give us a new email so that we can keep a list if that's your desire. I also have a LinkedIn group, and we really want to keep people in there talking and exchanging information and asking questions. Please check back with that, and we try to post new things that come out on the LinkedIn exchange as well. And I'm sure most of you are aware by now, but for those that aren't, you can order free brochures and publications in bulk. Going to this address, there's no cost, so if you need a set 25 for a class you're doing, you can do that. You also download from our website. So the resources, some of the resources we provide. I'm always happy to hear from our FINEX membership about any ideas and suggestions they have, so let us know. With that, I'm going to turn this over to Maria, who's going to handle the next presentation. We get her slides up, so just give me a quick minute. Maria, can you access the slides?
Yes, it looks like I have it. Thanks so much, Heather, and good day all. I'd like to start by thanking Dr. Brown and the CFPB for inviting CBA Credit Builders Alliance to present as part of their FINEX series. So my name is Maria Sennett, and I'm the Manager of Training and Program Development at Credit Builders Alliance. Heather mentioned CBA will be presenting a two-part series on the use of credit reports and credit scores as effective financial coaching tools. So as part of the first part of the series today, we will focus on strategies and techniques for integrating credit scores, reports, and your client's goals in your existing financial coaching processes, making the case for credit reports and coaching. So we'll really introduce a lot of the basics in this presentation, and in the second webinar, which will occur next month, January 10th, we'll go ahead and get down to the nitty-gritty, and we'll review a credit report and design a credit action plan for a client. So in that presentation, we'll discuss the various components of a credit report, identify what factors are necessary for consideration when assessing a client's credit situation, and then how to really design that credit action plan so it can really be as effective as possible and in line with the client's goals. So to get started, I'd actually like to get to know who is on the line with us today. You should see on the right-hand side of your screen a poll pop up, and I'm asking you just to select the best response of the options. So the question is, are you currently using credit reports in your financial coaching program? Again, we just want to choose one response, and the options are yes, we pull reports on a regular basis, sometimes, but only with a specific program, not yet, but we'd like to, or no, we do not see the value in pulling credit reports. So I'll go ahead and a second. I think it's still going.
See if the audience has, it says it's closed. Let me try this.
meantime, while Heather goes ahead to pull up the poll question again, I think maybe it closed a little earlier than anticipated. If you wouldn't mind maybe chatting in the chat box how you are using, if you are using a report, how you are using it in the programming. It's helpful to get the gauge of how people are currently using reports, and it will help us as we continue moving forward in these presentations. So again, feel free to chat some responses in the chat box. Heather goes ahead to pull that report up.
In trouble with that report. Can you see the results?
I can results because I don't have the polling on at this time. So one moment.
Let's just move on, then maybe some can share at the end how they're accessing them. I apologize. It looked like it's
no, that sounds great. Yeah. So by all means, anyone who has, if you're using credit reports currently in your financial coaching, if you just want to type that in, and we can go ahead and share as they're suggested at the very end how you might be using them. Today we'll go ahead and cover 4 topics. So we'll begin by sharing a little bit about Credit Builders Alliance and how we might serve as a resource as you continue to build out your own credit building toolkit. So touch on credit, all aspects of different credit components, including the credit report and credit score. Next, go ahead and cover some basics of it to lay the platform for the larger conversation we will have as we dive into discussing credit reports and scores. Thirdly, we'll go ahead and touch on the differences between models and how to identify what you should be pulling for your programs. And finally, we'll look at the integration piece. So we'll touch on simple ways to incorporate credit review into your existing processes. Hopefully by the end, if you're not already using credit reports in your coaching, we hope to convert you by continuing the value of the credit report into coaching programs. This whole simplicity of incorporating it into existing programming. I'm seeing a lot of different comments coming through the chat, so it's excellent. So we'll go ahead and share some of those comments at the end of the presentation. I'll just share a little bit about Credit Builders Alliance. Credit Builders Alliance, or CBA, is an innovative nonprofit social enterprise dedicated to building the capacity of a diverse and growing network of nonprofits across the country that help low and moderate income households build strong credit and other financial assets. So our credit building community is constantly growing. We're at about 510 members strong across the country. So our community is incredibly diverse, comprised of a wide variety of organizations, many similar to yours, serving everyone from social service agencies to multi-service and integrated service organizations such as United Ways, Local Initiative Support Corporation, Financial Opportunity Centers, Catholic Charities, Habitat for Humanity, as well as lender-focused organizations such as nonprofit community development financial institution loan funds, or better known as CDFIs, microenterprise development organizations, small credit unions, you name it, probably in our membership. So our mission at CBA is really to help organizations move people from poverty to prosperity through credit building. The CBA fulfills its mission by being as a bridge between the nonprofit sector and the credit industry. We support our members with access to bureau services, including credit reports, which I'll discuss today, as well as reporting for consumer and commercial lenders. So CBA also serves as a thought leader in the field of credit, dispersing best practices, training, consulting, and technical assistance services, aiming to strengthen the credit building programming, products, and education provided by our members across the network. So through our members, CBA services touch folks across all areas of the country, so everywhere from rural, suburban, urban, and tribal America. And our members primarily focus on serving the low to moderate income community of all, including persons with disabilities, veterans, immigrants, returning citizens, domestic violence survivors. Basically, inclusivity is a key here, so we really try to incorporate and have culturally competent material to serve everybody. So underscoring our philosophy is that a good credit file is essential to achieving financial stability. And we really believe that mission-driven nonprofits, probably many of you on the line, are really uniquely positioned to help individuals and families build an asset. I believe that credit is often the necessary asset to get ahead and stay ahead. So we appreciate everything that you're all doing on the ground and look to continue to highlight the great work that you are doing. So now to CBA, let's go ahead and start with some basics. We like to start off our presentations by asking, what is credit? Then I'd ask for some immediate responses when you hear that term. Because virtual, I will ask that you just reflect what immediately comes to mind when you think credit. Positive and negative associations with credit, or maybe just one of the two. So, our own perceptions around credit, and knowing that there are many different perceptions of credit helps us understand the importance of being aware of our own biases and notions before we begin working with clients. So this can really impact the conversation as we work with clients directly. So credit, very simply put, is the ability of a customer to obtain goods or services before payment based on the trust that a payment will be made in the future. So it's all about that relationship. The conversation of credit by looking at the root. So the word credit comes from the Latin cred, or credit, which means to trust, value, and worth. On the other hand, debt refers to as owed to others. While the two are not synonymous, for many of our clients, using too much credit may lead to crushing debt. But this does not have to be the case. Credit is really just a tool, and as with all tools, knowing how, being able to use them well is really the key to success. So at its core, credit allows you to buy something now and pay for it later, whereas debt, on the other hand, is a liability. So in understanding credit reports and credit scores, or the lack thereof, we can use these as proxies to determine whether individuals or small businesses can access a whole host of products and other opportunities, and at what cost. So credit is really critical throughout the conversation for our clients as we move to continue to grow our financial capability services. So I mentioned the origins of credit as oftentimes we experience a roadblock when it comes to credit. For many reasons, credit is often viewed as a deficit rather than as an asset. CBA, we believe that the first step towards helping clients strategically build credit in pursuit of financial goals is really to reframe from the negative association of credit to that with a positive message that credit is an asset. So we can do so by really helping clients and equipping clients with the knowledge necessary to understand what's on the credit report and use that information to set concrete goals to impact positive changes in their credit profile. Focusing on credit as an asset helps to empower individuals to take control of their credit profiles and financial goals. It's very much an empowering activity, and a simple sort of mind shift or paradigm shift can really help clients move forward in this journey. So we really think that starting with this can be a really good conversation as you begin financial capability services. Continuing on with some of the foundations around credit, I want to also go ahead and define some terminology here. So credit is confusing for all of us. And we use various terms when we talk about credit. We might get history, credit report, credit score. Some people use these terms interchangeably when they actually can mean different things. So let's review these basic terms to make sure that we're all on the same starting place. So to start, credit history or credit file is your overall experience with opening and managing credit accounts with different businesses. So we can think of this as a medical or job history. So regardless of what any set of records or resume might show, this is always going to be this, always going to continue to build upon this. As a credit report, on the other hand, is a snapshot of your credit history at a particular moment in time. And it's pulled for a specific purpose. So a person with credit history will have no credit report, but in time they might find as they are beginning to build credit that they do have history reporting on their credit report. The particular point in time is critical here. The next, or the last definition that we have on here is credit score. The credit score is a summary of the credit report boiled down to a 3-digit number designed to tell lenders and businesses how risky the consumer might be. So a person with no credit report will, of course, have no credit scores. At times, people with credit reports that don't contain much information or only information may also lack or have a very thin credit report and may lack a credit score for that reason as well. So they may be invisible. There's a lot of different terms, and we won't define them all in this presentation, but I do encourage you to look at the different terms and make sure we're using them accurately in our conversations. So with that foundation, let's begin by discussing credit reports. Many of you know, a credit report is a comprehensive tool that provides valuable insight into the individual's financial history, knowledge, and behavior. So it can really offer an understanding of a consumer's ability to make on-time payments, give us a sense of the amount of debt owed, one ability to access and use financial products, and whether consumers are searching for a certain type of credit. You learn a lot about an individual's history through a review of credit report, and you can find that it's a very emotional experience for many individuals as they maybe have never seen their credit report or poor past credit experiences, and being very understanding when reviewing is really critical to building that trust. So in other words, credit reports really provide us with a really solid sense of an individual's financial patterns, ability or stability to make ends meet, their debt obligations, ability to manage emergencies and to save, and lastly, access to asset building opportunities. So really reflecting potential for financial security if they're able to access the housing, the small business loan, or the account that they need to safely and securely hold their money. To know about credit reports, and we're not going to be able to go through everything in this presentation, I wanted to highlight 3 highlight points. And in next month's presentation, you'll be able to kind of hone in the more nitty-gritty, as I mentioned at the start, looking at an actual credit report. So a couple things that we want to highlight in this presentation was that, one, most importantly, there's not just one credit report, similar to credit scores. So credit reports are customized by data sellers for different businesses and for consumers. So today, for instance, we'll go ahead and dive into the differences between the consumer disclosure and then the business division credit reports, identify what might be the best suited depending on kind of your organizational goals. National Consumer Assistance Plan, which was a comprehensive series of initiatives designed to enhance the accuracy of credit reports, to the process of dealing with credit info easier and more transparent for consumers, yield a number of changes over the last 3 years. So I just want to highlight a couple of those changes. And if you haven't already become familiar with the National Consumer Assistance Plan, I would highly recommend looking into all the different changes that were brought about through that, because it's all designed to help the consumer. First of all, some of the changes brought about were around the institution of a 180-day waiting period before medical collections can report on a credit report, allowing consumers time to deal with any missed or late payments, and insurers sufficient time to catch up. Debt differs from other types of consumer debt in that it often arises from services that are involuntary, unplanned, unpredictable, and for which prices are rarely provided. And then secondly, because it can result from disputes or delays in payment related to inefficient insurance claims, having a larger window really can help support clients and the accuracy of the information when it is in fact reported. So that's a change that is impacting all individuals. Secondly, non-contractual debts no longer report. So these are your parking fines, your library fines, traffic violations, things that are really not predictive of credit behavior due to the NCAP are no longer reporting on the credit report. Lastly, another win for the consumer is that there is better dispute resolution, so more responses, multiple free reports. You are following up on dispute outcomes, so you have much more responsive nature around the handling of disputes. A little bit hairy for some. The update I want to provide is so through some changes brought about by the NCAP, we tax lien and civil judgments begin to come off the credit report. And as recently as April of 2018, this is now true of all tax liens and civil judgments, as opposed to only those that lacked accurate consumer personal identifying information, so full name, address, social security number, date of birth, and whose accounts were not verified for accuracy on the courts on a 90-day basis. So now the bureaus have a full opt-out policy when it comes to reporting these liens, and it also has impacted the reporting of civil judgments. So bankruptcies will continue to report on the credit report, but tax liens, both federal and state, civil judgments no longer report. So you're thinking, how is this impacting my clients? Is this a win, or how is this impacting my coaching? So per the Consumer Financial Protection Bureau's Consumer Credit Report Trends Public Records Report, which was released earlier this year in February, most public records were never accurately reported. So with exception of bankruptcies, which did not experience a change in status, as I mentioned. But civil judgments have fully disappeared from consumer reports as of July, and tax liens saw a decline between June and July of last year. So because of all of these changes, we saw this larger change brought about. This really impacts the review of credit reports and, in turn, credit coaching and counseling. While it's unlikely that most consumers will experience a significant credit score change, this impacts both lenders and financial coaches and counselors. So in particular, those supporting consumers in asset building activities, such as homeownership, lending, et cetera. So clients really should be informed that even if some public records no longer appear in the credit report, they should be aware of the consequences of this update on their ability to access loan products. They should never assume that clients are aware of outstanding public records. So always knowing that while some clients may be very public around the public record status, others may not be as aware or not be as vocal when sharing or when reviewing a credit report. So considering that as you do incorporate or continue to build out programming with credit reports, you might consider incorporating a question around public records, whether or not an individual is aware of whether they have public records and how that might impact their applications for credit or their applications for a mortgage. Because change is really new, a lot of people are less aware, and we're still waiting to kind of see how everything plays out, impacting individuals and their processes. So a couple best practices that we like to suggest are, as I mentioned, always making sure that clients are aware of the potential impact of the NCAP updates and the removal of the tax lien and civil judgments. So consider encouraging clients to self-report any public records that they are aware of, just paying attention to mail to ensure that you're staying on top of those. A review of a credit report regularly can also be a good avenue to support. And clients should always consider completing or providing complete personal identifying information when filling in loan applications. So you never want to have mixed reports or want an item misreported on an individual's credit report, and an easy way to help resolve in some cases may be just providing complete and accurate personal identifying information. Lenders specifically and homeownership agencies may wish to consider other opportunities for reviewing public record history. and this might be just on online public databases, but also might include third-party alternative data furnishers, such as LexisNexis Review Report, which does incorporate that data. So it really depends on the region of the country. For some, it's really easy to view public record data, and for other areas, it's less so. We could go on about some of those updates, but those are some kind of 3 high-level points I wanted to get across here. I mentioned that there's 2 types of credit reports. One is the Consumer Disclosure Report, and one of which is a Business Division Report. So I want to go ahead and start by discussing the Consumer Disclosure Report. So the Consumer Disclosure Report is designed for consumer education purposes as required by the Fair Credit Reporting Act. Designed to be consumer-friendly by providing instructions, and it contains detailed information around creditors and accounts, and it also includes all soft and hard inquiries. So it really provides the consumer with the most in-depth content around their credit situation and how everything's reporting. From a perspective, there are probably a few things we want to consider. First of all, it's great that the credit reports are available to consumers for free, and all consumers should really look to pull their credit report at annualcreditreport.com at least one time per year from all 3 of the bureaus. Then some individuals may also wish to use credit monitoring sites for both the credit report and the score. So some examples might include Karma, Credit Sesame, CreditWise. I think we've seen more and more advertisements around credit, and it's leading to a larger interest in folks accessing their credit. One challenge that we see with the Consumer Disclosure Report is that while it's designed for the consumer for educational purposes, it might be difficult for certain consumers to access due to the security questions, maybe challenging for some consumers. So when we access on annualcreditreport.com, for instance, consumer asked to some security questions, and those questions may pose difficulties for individuals when responding to those. And for certain people, depending on their circumstances, may also be difficult to access due to security features. In addition, reports sometimes overly detailed. So this is another area where, from a coach perspective, it can be overwhelming for a consumer to see just so much information around their credit. And while it's always helpful to identify creditor details and for disputes where necessary, sometimes too much information is overwhelming and can make for a more difficult process for the consumer. But having more information is always helpful, of course. And the easy-to-read format with explanations really help support the review from a consumer disclosure perspective. One perk of the Consumer Disclosure Report, and many of our members also use both the Consumer Disclosure Report to complement their Business Division Report. So in cases where more information is necessary, individuals or organizations may look to pull the additional credit report to supplement that which is provided by the Business Division Report. So it is great in that case. And then from a soft and hard inquiry perspective, we just always want to remember that hard inquiries are the only ones that impact the score. I think this is one area where the overly detailed sometimes comes to play. When it comes to the report, we just have to remember that only hard inquiries impact the score. So their Consumer Disclosure Report will see all the inquiries, both from their end as well as from the lender end. And only the ones where applications for credit occurred do we have to be worried about impacting our credit score. It's also helpful to review to ensure that no accounts have been opened by an identity thief, and it's initiated by both consumer and some businesses for educational and informational purposes. So just keeping in mind what the different inquiries or how the different inquiries might impact what we can gain from that Consumer Disclosure Report. So at the end of the day, we hope that everybody's pulling the Consumer Disclosure Report at least one time per year from each of the bureaus, as it's our right to access that information. From an organizational stance, the Consumer Disclosure Report may or may not be the best option when it comes to coaching and programming around credit. So another consideration is a business division report. The business division report is designed for lenders and businesses in order to make lending and other business decisions. So in this case, information may be consolidated and include codes and abbreviation. There's less information about creditors and accounts, and it only includes hard inquiries. So it's available to credit coaching and counseling organizations and lenders via data resellers or through CBA's Access service, which provides access to credit reports to credit coaching and counseling agencies. Does include a credit score, so oftentimes one drawback to the consumer disclosure report is the fact that it does not typically include a credit score. If it does, it might come at a cost. In this case, it is included, and it provides a more holistic picture because it is supporting the content that's reporting. The challenge here is that it comes with a higher cost for the provider. So just knowing that when you're looking at business division reports, it might provide and really complement the services that you provide, but it does come with a slight fee. The information is more condensed than the consumer disclosure report, which is helpful for reading, but then the coding might draw other questions. It's designed to protect the consumer, and therefore it's less detailed than the consumer disclosure report. So again, this is where you can see why it's beneficial to maybe use both or to at least look at the consumer disclosure at least one time a year. And then you can pull hard and soft inquiry reports as a lawyer and a soft inquiry as a coaching agency. So knowing that you have the ability to pull both is really helpful depending on whether or not you're using it in an educational stance or for a lending or underwriting purpose. And one drawback is it also doesn't provide as much insight into attempted fraudulent account openings, but again, the consumer disclosure report provides that. So as an organization, how do you go about deciding what you should do? So you're scoring inconsistencies between the report that your clients are viewing and what your lenders are reviewing, or you're working with populations experiencing difficulties addressing the report due to ID, address, etc., or you're assisting with home purchase or other asset building opportunities, or you're a lender. These are all circumstances where the business division report may be a right fit for you. So might be something to consider, and I kind of sped through the differences between the two and happy to answer any more questions, but this is really an area where it might complement. So if you're pulling, for instance, from TransUnion Direct, you're likely pulling a business division report. But if you're pulling annualcreditreport.com, or looking at a Credit Karma, you're looking at a consumer disclosure report. So those main differences. Let's have another poll. We'll go ahead and see if this one works out. So I do want to just ask, or take a second to ask, how do you access credit reports? And I'll ask that you just select all that apply. Are you pulling with the client and you're accessing through annualcreditreport.com or Credit Karma or myfico.com? Are you, or are you, do you have a direct bureau relationship with one of the three or all three of the credit bureaus, TransUnion, Experian, and Equifax? Are you pulling through data reseller, CoreLogic, Credco, or Kroll, or data reseller? Or are you a member of CBA, maybe using our CBA Access service? If you just take a second to go ahead and submit your answers, we'll just take a second to see if this works. If not, we'll continue through. We still have some content to cover. And then I'll let you go ahead and move the poll question forward whenever you're ready.
Okay. It looks like responses are slowing. I'll just give a couple more seconds, and then I'll go ahead and close it.
Great.
So, should the results, can you? Oh, that's quite. I'll be able to see the results.
Great. So it looks like many of us on the line today are using annual credit report or sharing with the client via one of the client access options. So annual credit report, Credit Karma, MyFICO. There are a number of individuals online that have direct credit bureau relationships, and even fewer that are data resellers or have relationship with a data reseller, CoreLogic, maybe some of our lenders on the line, or housing agencies. And then lastly, there are a couple of people who are using our CBA access service. Great.
We had a couple of people that said NA, so they just wrote it into the chat, so just so you know.
Great for that. And so we're hoping some of you might also consider looking at opportunities to incorporate it if you're not already, or carrying ways to add on multiple different services. Thank you so much for answering that question. So moving on from credit reports, we'll go ahead and touch on credit scores. So similar to credit reports, where there are many versions, the same is really true with credit scores. And this is where we think there's, a lot of confusion around credit. So lenders use different scores to measure risk for different types of lending. So lenders might be looking for slightly different characteristics in borrowers applying for different types of loans. So think auto lenders versus mortgage lenders versus credit card companies, landlords, insurance companies. And therefore, the risk modelers have developed many different algorithms to account for the differences that our lenders and businesses are looking at. So, of course, this can create some confusion if we're looking at a report online and seeing one score, and then we're working with a lender and getting another score. So why is it that credit scores vary? So there are many differences, and it could be any of these or a multitude of these different reasons why there are differences between credit scores. So the first might be because business sector, as I mentioned, so mortgage versus credit cards versus banking, and the risk assessment. So each company really decides what is of most value to them and might prioritize different loans over credit cards, and that hierarchy can impact one's credit score. And tied to that is the credit reporting agency. So each business determines whether or not they're going to report to all three of the bureaus, or maybe if they're only going to report to one or two bureaus. So that, of course, can also impact the credit that an individual has and creates differences and distinctions between the bureaus. On top of that, we have our different modelers and generations. So we have both VantageScore and we have FICO being two of the primary, whereas VantageScore keeps across the different credit reporting agencies, keeps the same features. With FICO, we're seeing different criteria coming into play for each, for TransUnion, different criteria for Experian, and different criteria for Equifax. So that can, again, create a little bit of discrepancies and challenges when trying to understand why our scores are different. Also, as we mentioned earlier, it really depends on the date that the credit score is also calculated. So if we're pulling a credit report today versus a month ago, we're going to be seeing some changes. Lenders are reporting or creditors are reporting on different dates. We might have late payments occur or balances drop on credit cards. All of these are new inquiries reporting. All of these different things will come into play and really begin to impact the score that one's seeing. And there's the quantity of credit score originators. So we see many that are also producing both proprietary and non-proprietary models. So the quantity of this can also impact the scores that we see on the market. So I'm creating a little bit of some confusion around different credit scores. So with that, I just want to go ahead and mention, you're probably very familiar with the two primary models out there, one created through FICO and the other created through Vantage. So FICO today is still used, this is the oldest model, so it was created by Fair Isaac Corporation, and it is used by about 90% of lenders. FICO has come out with multiple generations of the FICO score over the last 25 years, so constantly innovating to ensure that they're staying on top of market trends and kind of changes just from a regulatory environment as well from consumer demand. Also, they develop a separate FICO credit score model depending on each bureau. So again, a lot of distinctions between TransUnion, Experian, and Equifax and the FICO score. So there's a multitude of different FICO scores because of the generations, because of the different scorecards, depending on who's reporting and bureaus being reported to. VantageScore is a little bit newer. It was introduced in 2006, and it was created jointly by the three major credit bureaus, TransUnion, Experian, and Equifax, in order to create a more consumer-friendly and accessible credit score. It is being used by a growing number of lenders, so more and more every year. And there have also, similar to FICO, been a multitude of generations developed over the last 12 years, but fewer than in the FICO model in this case. As I mentioned, also VantageScore, distinctly from FICO, has one algorithm, and it is used across each bureau's data, so it makes it a little bit easier sometimes to when reviewing across the different bureaus. When at scores, there are a variety of different places to do so. And again, we have to be careful because we don't remember too sure always which score might be offered. But for free, via financial institutions, credit card issuers, credit sites, or Credit Karma, nonprofit credit and financial counseling programs. So I know they're shown a CFPB resource, and we always refer to that as well. There's a growing list of organizations that are pulling and providing free credit scores. What's critical to do is when you are reviewing this is to always confirm the score type by reviewing the fine print. So when it comes especially to the FICO score, ensuring that the trademark is also shown, because just because it says it's a free credit score, it doesn't mean it's just a free FICO credit score or free Vantage score. So always confirming what type of score is being provided is critical, and most options should be able to provide that information. That's a smaller print than some of the actual credit score. You can also consider purchasing credit scores with the business division reports. So as I mentioned, that's a huge perk of the business division versus a consumer disclosure report. So the fact that you can access some of those credit scores. And nonprofits, and whether it be a credit coaching agency or a social service agency, whatever the nature of the nonprofit, 501c3s have the ability to select the bureau and the credit score generation that they wish to view, and or to also incorporate multiple options in their own report. So it really offers, the business division report offers the ability to customize a little bit more based upon your organizational goals and the mission of the work that you're doing. For those organizations that are pulling through business division reports, so through TransUnion Direct, through other avenues, there's the opportunity to disclose FICO scores specifically through the FICO Open Access for Credit and Financial Counseling. So this program for nonprofit organizations, and a way for nonprofits to share the credit score that they're purchasing with the client. So this was the first way that FICO, or the first program that allows organizations to share that score directly with clients. Cases, the score is not shareable without use of this program. So it's a way, and it doesn't cost anything to join the program, and it offers a great opportunity for organizations. So many different credit scores out there and so many free platforms. We just want to offer a couple of pros and cons of the different platforms. So when accessing for free, some pros are that it does provide summarized credit information, it provides free credit scores or personalized recommendations and product recommendations. Some cons of some of the free platforms are that they're not ideal if consumers need detailed credit report information. They can be difficult to access for people without a social security number or who have difficulty answering detailed security questions. Always clear score version is offered, and again, this is an area where we must refine print. So when working with clients and you're using a free credit score platform, if it doesn't read FICO score with a registered trademark, it's not. So I think that's always a really important point to highlight. And then customers must share personal information when completing some of the free credit score platforms, and they may also receive marketing messages. So for better or for worse, as long as an individual is aware of these things, just as long as you're using maybe one platform, it can also help support in a regular issue of reports and understanding the credit building journey more on a large scale. So as you can see, there's so many scores, and the scores that your clients may see through online resources or coaching may be different than the actual score. It can be very easy to become overwhelming. So we want to make sure that we're always reframing that credit scores are overwhelming or that credit's overwhelming. We can do so by really focusing on the trend upwards. So from credit score improvement on some of those free credit platforms, that's what our clients are using. That's a positive. If we're seeing score range change, if we're seeing an individual moving from subprime to prime, that's also one of the largest changes we're always looking for. And then most importantly, the financial actions that lead to good credit. And these are often very visible in the credit report. So whether or not an individual is able to pay on time, keep a balance, and maintain regular activity on their credit accounts. These are all really important and visible items that the scores are just reflective of. Credit scores will, regardless of the type of credit score, will generally improve if the underlying actions improve. There's no positive activity report, there can be no credit building. So again, this is a quick peek of some of the information, but kind of connecting from credit reports and credit scores and the value that each provides and integrating it into the financial coaching. We believe that credit and financial coaching are really an ideal match. Starting off, you really, coaching relationships are ones built upon trust. And credit is and I need to form my slide here. And credit really is a situation where trust is really necessary to help support clients. It's poised to offer support through a strengths-based, client-driven process, financial coaching, and the same goes with credit. We're really looking for the client to drive the session, for them to identify any natural connection to financial goals, and as a financial coach, being able to support their journey, understanding their goals is really the role that we see, and we see that credit really can help enhance that. Reports can also offer additional outcome tracking metrics. So from a credit report stance, from a credit score stance, there are many different metrics that can be drawn from those areas, and they can also help improve and highlight the impact of financial coaching. Values in a survey that from our CBA members around the value of credit reports. Credit reports really help their staff better understand and address clients' individual credit profiles, challenges, and opportunities. So whether it's directly integrated as a separate service or it's connected to other aspects of programming, it can help understand what a client is facing. It's an opportunity for clients to feel empowered because they have an understanding of the credit system, and they can own their financial situation. So they can, knowing what they can do to improve their situation or improve their credit is really powerful, and we see the impact directly as individuals move forward with the credit knowledge, provide credit strength necessary to achieve those goals. It also really improves members' abilities to measure client and credit financial progress and success over time. So again, it's the outcome tracking. It's a great metric. And lastly, for members, credit really helps incentivize client participation in credit and financial education and coaching programming. So it offers a series of teachable moments that are very tangible, and it's a reason it provides like a carrot to continue the conversation. People often, once they understand the value of credit, become really excited and want to continue to work towards improving their credit. And that's the value of having the credit report and the score that can help guide that process.
Maria?
Yeah.
Hi. I just wanted to, we're bumped up against 3 here. We've got about 2 minutes left. So I wanted to know if you wanted to take a few questions and let Carmina finish the rest of the slides in the next session in January, or did you want to go ahead and finish and skip the questions and let her answer those next time?
Go ahead. I'm almost done. I'll go ahead and wrap up really quickly with a brief comment on each, and then we can go ahead and take questions if things. So from a project mapping stance, credit really can intersect at all different areas. So you can see different areas here listed here. And you talk about credit, we want credit to be a continuous part of the conversation. So this is a benefit, again, of intersection in various components in various areas. So at intake, it gives you a good starting point prior to any applications, gives you a sense of ensuring that the client's going to access and be ready for the process that they're applying for. Then as part of an ongoing coaching and support strategy to build financial stability, it provides the continuous motivation to continue through the process, even when times can get rough, because credit is not always as glamorous as we know, but it can provide access to financial goals that individuals are looking to achieve. So credit is just one step in the journey, but it's an integral piece. So credit as a silo is really not as beneficial as intersection of credit into existing programming. So whether it be talking about savings, whether it be about accessing different opportunities such as home purchase, or whether it be just simply about building credit, there are many different ways that credit really integrates into and is a part of the larger financial security equation. And then as far as a call to action, it's important for all of us to look at different ways to educate our clients on how to pull credit reports and why lenders see something different. It's with local lenders to learn which score and report versions they're using. This can really help enhance and win-win for all people involved, the financial institution, the client, and the organization, because you're building upon relationships and allowing individuals to access services that they can access. And then identify all intersection points with credit reports and scores in your current program. So these are the big three takeaways that I hope that you've walked away with from this presentation. And as Heather mentioned, we'll have a second section of this webinar series, which is just honing in on reading a credit report and designing a credit action plan. So begin to take some of the larger, higher level education knowledge into practice when it comes to actual incorporation in a program. With that, Heather, I will open it back or hand it back over to you for any questions. And obviously, we're close to time here, so feel free to also pass along additional questions on this email listed here, programs@creditbuildersalliance.org. We'd be happy to answer any additional questions that we don't get to today on the line.
Thank you, Maria, for such an excellent, informative, and packed session. You got a lot into an hour, and it was really great. Operator, we're going to try to take some questions on the line, and I'm going to, I guess, if you will give them the instructions for asking a question, and I will, while we're waiting to see if anybody asks, I'll read through some of the questions that we have on the screen. For those that need to go, we understand. You can email your questions. For those that want to hang on and get their questions answered, we'll do the best we can to get through them in the next 5 or so minutes. Operator?
We'll begin our formal question and answer session. If you would like to ask your question, please unmute your phone, *1. Only record your first and last name. To withdraw your question, you may press *2. Once again, in order to ask your question, please press *1 on your touch-tone phone. One moment, first question.
Okay, one question. I wanted to point out several people did comment they are pulling reports already, so that's great to see. And some people are using it to determine mortgage readiness, or just seem to be doing general counseling. There's some that aren't, that would like to, so you have the programs at creditbuildersalliance.com information you can call, .org to get more information on that. So quite a few comments around pulling credit, and it's good to see that that's happening and what people are using. Question about hard versus soft pulls. I think you answered that, Maria, as we went through. It's basically a hard pull means that you're actually doing a loan credit check and it shows up on your credit versus a soft pull showing up. We did have somebody that asked that they wanted to confirm that there should be no outstanding federal or state tax liens credit report any longer. Can you get that, Maria?
So the question was why that's reporting, or how one can access
The last question was, no outside federal or state tax liens should be on, the person is trying to confirm that there should be no federal or state tax liens on credit. Is that true, that they should all be gone at this point?
That is correct. So under public records on the credit report, the only information that should still be reporting is the information around bankruptcy.
Okay, you asked how to get the slides, and if, you can download them from the presentation, or you can send an email to the next mailbox, which sent you an email about this presentation, and we can send you the slides. I recommend that organizations use FICO 8 or FICO 9. I really got into that level of detail. My understanding is FICO 9 is the current version, but a lot of people aren't. It hasn't been approved by HUD for housing. Is that correct?
When it comes to housing, FICO 4 is actually the version that most lenders use, and this is really where I mentioned that getting in touch with your local lenders can really help highlight what's best for them, depending on the kind of goal that you're assisting clients with. From our understanding, FICO 8 is the most widely used of the FICO versions at this point in time. FICO 9 is still newer on the market, and when we introduce new products, new credit score models, what happens is it takes some time before each lender is ready to incorporate that into their own lending and credit programming. So in terms of an underwriting and a program stance, it takes time to implement and incorporate. So while it's important to stay on top of new models on the market and what they're offering, they may or may not be really what the client's actually seeing from a practical stance.
Oh, operator, we can take some calls from the line now. Thank you.
Sir, first question is coming from Kara Stanley. Your line is open.
My first question, I had two, and they're quick. How do you copy of the recording? I think you said you can get it from one of the emails, I think.
We will post the recordings online, and as well, if you send a note to our mailbox and you just want a copy sent to you, I can do that as well. The files are you can download them from your file menu on the actual presentation while it's live now for the next few minutes. If you have to also email the text box.
Because it didn't come, my manager sent it to me. That's how I got the email, so that's what I was wondering.
Oh, definitely. Then send an email to CFPB _FINEX at CFP.gov. I'll type it in, and you can get on our mailing list as well. Thank you.
Okay, thank you. My last question was about student loans and how do they affect the reports?
Yeah, student loans, we didn't touch on that today, but if they're reporting on the credit report, it can impact, and ideally it would impact in a positive way, but of course there's also a lot of repayment opportunities, especially for federal loans. I would recommend looking at some of the federal resources around student loans and repayment options, but if they're reported to the credit bureaus, they're similar to any sort of installment account or a loan option. So it should benefit and improve if paying on time, or it can drop one score if not in a positive repayment plan.
Okay. Maria, are there any other questions?
We have other questions in queue at this time. As a reminder, you may press *1 on your touch-tone phone.
Okay. Let me try. I didn't miss any other questions in the Q&A, and then some of the sites said it didn't work to get the free credit score, but if you actually go to, I'll pull up my slide that has our location on our website, and if you go to this first URL, consumerfinance.gov, adult financial education, and do a search on credit, you get information on places that offer free credit scores. So that might be a good way to do that. As you mentioned, the delay in medical collection reporting is reduced weight of medical collections for how much it impacts the score. Remember that one? I can answer that.
That would go into more detail. What I would say is some of the models some of the newer models, encourage a weight reduction, but that'd be something to look into more specifically because there's more around that information. But definitely knowing that, yes, it depends on the model as to whether or not that reduction is calculated into the credit score. It's true for both the newer FICO 9 and, for the newer FICO and VantageScore models out there.
Okay, wonderful. Well, with that, operator, if there are no other calls waiting, we'll probably wrap up. We've held Maria over and other participants. We thank everybody for joining, and we'll hope to see you on January 10th from 2 to 3 Eastern Time. Have a wonderful holiday season and talk with everyone in the new year.